Hi friends, welcome to Jaya Learning Tree channel. How are you all? I hope you all doing good. Okay friends, let's see today's topic. Today's topic is how the banking sector or the banks will decide the interest rates. I have come up with few indexation which decide the interest rates from time to time. We'll see what is this indexes. First one is benchmark prime lending rate and base rate. Then at presently the banks were following marginal cost of lending rate. Okay friends, we'll see one by one. What is benchmark prime lending rate? It was introduced in April 2003. It is usually decided by the credit-worthy people. Credit-worthy people means the big influence or big businessmen. For example, Vijay Mallya, the big businessman, not now. Now is a big bankrupt. You all very well know about this. Okay, friends. How the Vijay Mallya lobbying with the banks with the less interest rates only for him. That is why we call it as there is no transparency in the benchmark prime lending rate. That is why the banking sector were facing the huge NPAs. This is one of the prime reason we can say. The Reserve Bank of India conducted the survey and finally the report says that in 2003 77% of the banks were following this benchmark prime lending rate. Finally, it was replaced by the base rate under the chairmanship of Deepak Mohanty. What is this base rate? Is this base rate as a transparency? We'll see. It is a interest rate with the scheduled commercial banks will lend no loans to its customers below the floor rate of the interest. Whatever the base rate as fixes the interest, below that no the scheduled commercial banks will lend the interest rate to the borrowers. That is what base rate. We'll see how this base rate will considers the interest rates. It brought in 2008 after we faces the financial crisis. Reserve Bank of India find the discrepancies and finally they have conducted the one committee. It was headed by the Deepak Mohanty chairmanship and finally by the Deepak Mohanty report benchmark prime lending rate was replaced by base rate. Okay. It is followed some formula. It is based on indicative formula. Interest is equal to base rate plus spread. Friends, what is the spread in banking sector? I think you all well aware what is spread in stock exchanges, right? Then what is spread in banking? Yes, spread is nothing but a difference between the basic lending rate and the final interest charged to the borrower. This is what spread in the banking sector. How they will they decide this interest rate? They will decide based on the cost of funds like deposits, savings, current accounts, term deposits or term loans. These are all the consideration they will take into the account, friends. It also includes overhead cost, average return on net worth, on equity and debt by the bank management. By considering all this overhead cost and net worth on equity and debt, we can say there is a lack of transparency in the base rate too. That is why to cover these discrepancies, they brought the marginal cost of lending rate. Okay friends, Here is some historical perspective of the base rate. It will help for the examination we have given. For example, they will ask in the net SLET examination or else in the KPSC, UPSC too, they might ask under which chairmanship the base rate was introduced or else when it was introduced, like that. Have a look on this, friends. Okay, friends, I hope you understood what is base rate and what is benchmark prime lending rate. We'll see. Presently the banking sector is following marginal cost funds based lending rate. What is this? As I said, in base rate, what they are following to in the formula, they are following the indicating formula. But in this marginal cost of lending rate, they will following the prescribed formula. In the prescribed formula, interest rate is equal to marginal cost lending rate plus spread. As I said before itself, I said what is spread in the banking. Then we'll see what and all it includes. The marginal cost lending rates, it includes the operating cost plus marginal cost of funds like repo rate, deposit interest rate, return on net worth, received every month deposits. Okay, in the base rate, what they have considered the cost of funds, like for example like savings, current and term, they are followed. There is a lack of repo rate, friends, in this base rate. That is why we say base rate as a no transparency. In this marginal cost of lending rate, they consider the repo rate. I think you all know what is repo rate, what is the impact of repo rate, isn't it? Whatever the commercial banks borrowing the funds from the Reserve Bank of India for certain percentage of the interest, that is what repo rate, right? Yes, that is why we call it as a transparency, because every quarterly the monetary policy will decide the on the basis of the inflation, they will decide and fix the repo rate charges, isn't it? It will reflect in the marginal cost of lending rate for overnight to 1 year. Okay, it is applicable from 1st April 2016, friends. Okay, whenever the RBI reduces the repo rate or they increases the repo rate, this marginal cost based lending rate formula includes the repo rate. It automatically reflects in the normal interest rate the banks which were lending to the customers, friends. I hope you understood what is the effect, what is the transparency is there in the marginal cost of lending rate. Okay, friends, we'll see what are all the exemptions. Are the interest rates are same for all the sectors or else there are exemptions? Yes, there are exemptions. Few exemptions are there. For example, there are three primary exemptions in banking sector. For example, we used to take personal loans, house loans, like that. Those interests are very high, but all the person cannot afford the same interest rate. Few backward class peoples are there, they cannot pay the same interest rate as the corporate people will pay. Okay, for them they will exempted from these indexation charges. Okay, those exemptions are loan granted under differentiated rate of interest scheme. Second one is loans to the own employees of the bank, including retiring employees. Then loans to depositors of the bank against their own deposits. These are all the exemptions from the marginal cost lending rate. Okay, why they have made exemptions to these people because of the financial inclusion purposes. We'll see what are differential rate of interest loans. It is introduced in 1972 by Government of India. Friends, it is nothing but an priority sector lending loans. You have all learned about in banking sector. In 1972, they introduced the priority sector lending because there is no credit spread in the all the sectors in the rural area. That is why the Government of India thought the priority sector lending should be the best to spread the credit for the poorest among the poor. Okay. What is this priority sector lending? The Government of India given the target to the banks, some percentage, for example 40% of the loans to be should be lent to the particular sector. For example, out of 40 percentage, 15% will goes to the agriculture, 7 or 12% will goes to the MSMEs, like that. This is what differential rate of interest. Usually they will charge 4% per annum, friends. I hope you understood what is differential rate of interest. That too, no collateral securities, they will pay the loans to these sectors. What are the other exemptions from the base rate? For example, in case of crop loan, up to 3 lakh, okay, or else for the export credit advances, or else for the scheme like Jawaharlal Nehru National Solar Missions and many other schemes. These are all the exemptions from the base rate and marginal cost of lending rate. I hope you got an clarity how the banks will charge the interest. What are all the procedures and norms they are following to fix the interest rate while lending. Okay, friends. I hope you understood. Thank you. Please share and subscribe our channel. Keep sharing, friends. We all learned from the childhood. Sharing is caring, right? Please share and care your friends too. And also keep supporting us. Thank you, friends.